Welcome back, traders and investors. We have Ralph Acampora on, Director of Technical Analysis for Altaira Wealth Management. Ralph, I've been watching you for a long time. I think, were you ever like on Wall Street Week with like Rukeyser or that other
Oh,
show?
sure.
Yeah, that was, I remember watching
Yeah,
that. Yep. I remember,
Joel, you're dating yourself. Yes.
no, I remember,
That was a wonderful show. That was a wonderful. Lou did a spectacular job.
And I just remember you talking about technical analysis back then, and it's something that you've followed for a long time. And
hmm
this is a secular bull market here defined. What kind of technicals do you use?
Well, I like to be simplistic. Today, I think there's a lot of sophistication, and I think it's information overload. Having said that, I start my day out with a spreadsheet, and I literally follow anything that moves. I put my support and resistance levels on everything that I look at, and I follow a lot of ETFs. So whenever these levels are broken, it flashes to me, and I have to update it. Okay, so I'm a bottom-up guy. I like to look at graphs or charts specifically. There are a couple of indicators that I like to look at. RSI, which is the stock relevant to itself, and then the old MACDs, where you get the moving average crossovers. And I'm a good old-fashioned Dow theory follower.
Talk about the Dow theory, because a lot of people don't
Mm-hmm.
talk about that anymore. Can you explain that to our listeners?
Dennis, it's the oldest theory in the subject, and Charles Dow, when he first started, and this is in the late 1800s, like 1885, being a newspaper reporter, and he didn't have the ability to talk to corporate America, because there were no SEC, no rulings. They didn't have to divulge earnings or anything. And there were no economists in those days. And the most important industry in the United States in the late 1800s was railroads. So he created the railroad average. That was his first index. And he thought, well, if this big industry does well, the country will do well. Well, it didn't work. And he said to himself, what am I missing? What he was missing was companies that produced products. So that was the second index, is Dow Jones Industrials. And the two of them, the producers of products and the shippers of these products, are both interdependent parts of the economy. And if they're both doing well, that means we're in a primary bull market. If they're both moving down or you have divergences, you're probably either in a secondary correction or a bear market. It's really simple to look at. The first 4 months of this year, I had a little bit of a problem with Dow theory because the industrials couldn't make a new high, but the transportation was. And I'd say a month and a half ago, that changed. Dow Industrial is making new highs, confirmed by the transport. So as far as Dow theory is concerned, this is a primary bull market.
Okay, with the Dow, we've talked about it. Dennis and I like to, follow the S&P 500 because it's a much broader index, and when you get changes in the constituents in it, it doesn't have a big effect. Where with the Dow, I mean, they I don't want to say they're doing it all the time, but
30 companies
yeah,
only. So when you
it's
change three components, it's 10% of the index.
yeah. I mean, does
hmm
that in your opinion, does that hurt the Dow's credibility at all?
No, not really. Um, First of all, I hear what you're saying about the S&P 500. I could drill a lot of holes through the S&P 500, guys. It's cap weighted, capitalization weighted. You take the
hmm
first 100 stocks in the S&P 500. I'd say that's roughly about 75% or maybe even 80% of the entire weight of the S&P 500. So when they
Right.
say there are 500 stocks in there, that's nonsense. There are about 150 stocks in there that really dictate. So having said that, the problem with the Dow Jones Industrial is arithmetic. In other words, you add up to 30 closes at the end of the day and divide by a divisor. Well, when you originally created, the divisor was 30. But now, after so many years and so many stock splits and new issues put in and taken out of the index, I think it's 0.1245 or something like that. I mean, it's a multiplier, not a divisor. Yeah. So, but I don't know. I like it anyway. The most important thing about the Dow is that everybody out there, most of the public, they can relate to the Dow.
Right.
Charles Dow did a heck of a job publicizing his index. He has a lot of followers.
Yeah, like I mean, when I'm walking on the street, somebody will say, "Oh, the market was up 100 points today." They don't say, "Oh,
No,
the S&P point was up 10 points today." It's probably the bigger
absolutely,
number, and it's just that's what people talk about.
absolutely, yeah, absolutely correct. And one of the better averages is the value line because it's unweighted. They're not cap weighted, and it's not arithmetic. And if you ask someone about the value line, they say, "Excuse me, are you sick or something?" They just they have no idea what that one is.
You said you'd like to follow ETFs. I mean, is that just because the ETFs have a basket of stocks and then give a more general
Mm.
a trend? And when did you start to make this transition into ETFs?
Well, ETFs are only out. I'm going to say 4 or 5 years. Maybe I'm off by a year or so, but it's relatively recent, and I enjoy them because if you like a sector like the 10 S&P sectors, you get ETFs for them. If you're really into energy and you're debating whether you should buy Exxon or Chevron or something like that, you can literally buy a basket of energy stocks. That's one thing. It cuts out the stock selection part. And the second thing is just a handful of ETFs. I mean, you can look at the world globally. You got the EWJ is Japan, and it's fabulous. I mean, I can visualize that I can follow the world with a handful of ETFs.
Okay. Do you follow the commodities markets at all? Gold and crude.
Sure. Yep. Um, you can't watch one without the other. That's a guy by the name of John Murphy who wrote several great books on technical analysis, coined a phrase called intermarket analysis. Intermarket analysis means looking at stocks, but also looking at other things outside of equities that will affect equities, like gold prices, interest rates, and things like that.
I
So
mean, there's
yes,
no
I do
greater
that.
example than yesterday too, with crude flying up to new highs on the move, up $2, and you saw airlines just turn around and get crushed there yesterday on that news. So, you,
Absolutely,
do you
absolutely. Great example of that, yes.
do you think this crude move continues here?
Well, if I knew exactly what was going to happen in Iraq and Syria and places like that, I think I'd have the answer to that. I think, you've heard this many times. Markets hate uncertainty, and God knows there's so much uncertainty caused by this crisis out there. So, no, I think the pressure on crude is probably to the upside for a while.
Ralph, I've been following your predictions for years, and I like you come out and you kind of made some big predictions on the upside, and I wish I would have listened to them. But I mean, I'm sure for the amount of time that you've been in the industry here, you've made a lot of different calls in this market.
Mhm.
And
Mhm.
do you just? I mean, obviously you keep track of them. I mean, when did you have the Dow from your How early did you predict the Dow was going to go to 17,000? I mean, roughly. Haven't quite made it there yet. But do you know
Um,
when in your studies that that you made that determination?
um, well, the most recent call of 17,000 that was made a couple of years ago. I think that was made. Yeah, I'd say about 2 years ago, 3 years ago. I actually wrote a book a long time ago, and the target was the Dow 20,000,
Correct.
but it had to get there by the year 2011. So I'm off by a few years.
Okay.
But a little thing like subprime got in the way. But the theme of that book, if I'll go quickly, the theme of the book was mega markets um, after the world after major wars. And I went back to what happened to the markets after the Civil War, when you downsized in the military, after the First World War, Second World War, and I was doing it after the Cold War. And the theory was that we have the longest stretch of peace in Europe since the Holy Roman Empire. Can you believe that?
Nope.
No fighting. Everybody's living and happy. So we lost 60 million people in the Second World War. And I'm saying these 60 million people or their relatives are alive today. And that was the theme of the book, that we have more and more people that are more and more productive, et cetera, et cetera, et cetera. And, well, we were doing all right up until 2007, 8, and 9. But actually, if I were to rewrite the book today, 60 million people is nothing. In the last 15 years, we've all witnessed this great insurgence of people coming into the middle class in China and India. Now you're talking 350 million people. Now these people want to eat. They want to eat chicken and beef and pork and stuff, and all these animals have to be fed. And the famous investor Warren Buffett bought Burlington Northern Railroad because he could send the corn and wheat out to the California, so they can send it to China. And a lot of industries are doing very, very well as a result. And I think that's a big part of my secular call for the next 10 or 15 years is the growth in the world.
Okay, we have Ralph Acampora on the line, Director of Technical Analysis for Altaira Wealth Management. Ralph, we got a question for you coming out of the chat room here, going into some fundamentals. What do you make out of the Bank of England governor's statement that rates could rise sooner than later?
Obviously, that would impact the stock market if it were to actually happen. But people get so upset and so nervous that rates are going to rise. Markets can go up with rising rates. It's when interest rates get to an extreme level, then you have to worry. And then the challenge between fixed income and equities changes. But for example, I recently had a conversation with a young man who was very upset that mortgage rates were going up to 4%. I looked at him and I said, "You got to be kidding." I paid 10.5% on my apartment I bought in New York City, 25 years ago, whenever I bought it. So, no, yes, I think on a short-term basis, it would probably cause the market a little bit of anxiety, but I don't think it would be significant just yet.
Okay. Reflecting on all your years in the business, do you remember your best market call and your worst market call?
Mm-hmm. My best market call was Dow 7000, and I wrote this report in June of 1995. Just prior to that, the market went up 900 points without a correction. And that was like unheard of. I remember an old conversation I had with the oldest technician I ever met. His name was Ken Ward. He was 85 years old in 1970 when I met him. I asked him, what was the most difficult market you ever lived in, Mr. Ward? He said, and I said, it had to be the crash of 29. He says, no, young man, it was the early 60s. I said, but Mr. Ward, it went up. He said, it rolled over all of us. You know what we had then, and we have today, by the way, in common with that secular bull market that he was talking about? Today we have low inflation, low interest rates, and that's exactly what we had in 1995 when I wrote it. And that was my best call because in a year and a half or 2 years later, it hit 7,000. And then I pushed it up to 10,000. My worst call was the crash of 79. I'm sorry, the crash of 1987. Like many technicians, I was looking for a correction, but a few of them really nailed it. Bob Proctor, Elliott Wave was looking for a crash. My old friend Money's Why was looking for a crash. Speaking of Wall Street Week, he was on Wall Street Week,
I remember Marty.
literally crying that there was going to be a crash. And I guess maybe I just didn't want to believe it. So I missed that one.
Okay, so looking forward now, I mean, we've had this incredible run in the Dow, since the '09 low, and a lot of the public is underinvested in the market. How would you approach someone that, let's say, they're in their early 20s, just getting out of college, having some disposable income to put into the markets? What kind of suggestions would you give to them?
That's a great question. You're right. The public's not in the market. The bulk of that is the baby boom generation. They're about to retire or are retiring. The last thing they don't want to do is take a risk. So I don't expect that generation to come in anytime soon. But there's nothing like the lure of rising stock prices. If I'm right, over the next 5, 6, 7 years, even longer than that, we get eventually the market continues going higher. You lure in some of that money. But younger people, this young generation now, I think they will come in because the technology is there for them to experience this, and most of them will be encouraged because they're young and they should participate in the growing economy. So we'll see the young people come in.
And along these lines, with the bull-bear spread at extreme levels, would it be best to just kind of sit on the hands at this point and wait till you get a nice pullback to potential support levels, or do you suggest some dollar cost averaging, or just all in?
Yeah. Well, I got to tell you, it was in April of this year. I was on one of the TV shows, and I said I was looking for a meaningful correction. I was looking for, and that's when the Amazons and the Yelps and the Twitter and everything were falling out of bed, and that was part of my concern. And other things were happening that concerned me. I remember I mentioned the Dow theory. There's a bit of a problem with that at the time. And I got a lot of coverage because people. I made one comment saying I have the sick feeling. You got to be careful what you say in the press because that got picked up. That phrase, sick feeling. Oh, Acampora has a sick feeling. And I was right for about 2 weeks. And then that thing just turned in May, which was really, really impressive. And its ability in May and here in June for the industrials to make a new high and everything, a lot of the sectors that were looking heavy technically came back very, very quickly. So a few weeks after that, I put my correction on hold. But, I look at seasonal things. This is the second year of the president's term in office. It's a 4-year cycle, and I don't want to get too technical. But sometime between May and October, it's likely that we'll get a correction. Now, it doesn't have to be a major correction because I don't see any major problems yet. But I think it would be healthy for the market. So to answer your question, if you had stocks that look attractive and not overextended, and I'll give you some names. You got to look at the old names that people can relate to. No, excuse me, I'll take it back. People can't relate to because they forgot them, like GE, General Electric. I think it's $27, $28. Texas Instruments, I think it's about $47, $48. Microsoft, Cisco, Intel. Young kids are talking about Netflix and Tesla and things like that. And these names that I just gave you are under the radar. I would be buying those.
Okay.
If they're not overextended.
Okay. Another question here. Do you think technical analysis has come full circle back in the tech bubble? No one really paid that much attention to it, and now most new traders and old traders alike have technical analysis to spin their work. Do you think it's come full circle?
Well, that's a wonderful question. As you know, I've spent my entire career proselytizing for technical. I've been teaching technical analysis in Wall Street since 1970, and taught most of the traders on the floor. Bill Griffith on CNBC was a student of mine, et cetera. So I'm very proud of that. And so I am very active in supporting and pushing for technical analysis. You're absolutely right, because this day and age, especially with the advent of the computers, everybody's got a picture in front of them. Everybody's got a chart. And that's the good news. The bad news that not everybody can read them. It's not that simple. You have to know what you're doing. And I think there are a lot of talking heads that say lots of things about technical analysis, and I think that's why they should all be educated. There's the certification exam called the Chartered Market Technician, CMP exam. That's like the CFA for fundamentalists. To get really educated in it, absolutely. I think the popularity of technical analysis will continue. I think this is, in fact, I was told the other day that more people taking the CMT exam, or the candidates taking the CMT exam, many more of them already have a CFA designation. That's encouraging. So in other words, I call that fusion analysis when you take fundamentals and technical and blend them. And I always try to do that.
Okay, one last question here from Harlan Pine, all about trends, and he wants to know if you still spend Sunday mornings peeling through hard copies of daily charts. He says that's the best advice he ever received.
That's great. Yeah, there was a chart service called Mansfield. Okay, Mansfield used to get hand delivered to my apartment every Saturday morning. It was a big, thick compilation of charts. They had all the New York, all the American, and all the over-the-counter stocks. And it depended on what I was doing that weekend, whether I started on Saturday or I started on Sunday. But I would spend hours just flipping through them. Absolutely. And I was just told that Piper Jaffray in Minneapolis just bought the Mansfield service. So that's available again. Isn't that wonderful? It didn't die. So good old charts? Yes, absolutely. Nothing like having them in your hand.
Okay, we've had Ralph Acampora on, Director of Technical Analysis for Altaira Wealth Management, a veteran of these markets. Ralph, thanks for your insight. We'd like to have you back on again.
Thank you, Joel, and thanks, Dennis, for the questions. I hope it was okay.
Yeah, it was great. Thank you.